again, this is the Property and Casualty meeting for NCOIL. For those of you who may not know, my name is Edmund Jordan. I chaired the Financial Services at Multi-Lines last year, and now happy to be back here as the chair of Property and Casualty. I'd ask for a motion to waive the quorum. Second. So probably move the second. All in favor? Opposed? Quorum is waived. All right. I need a motion as well to approve the November 18th, 2022 and the February 17th, 2023 committee meeting minutes. Second. All in favor? Opposed? All right. Those minutes are adopted. All right. Today we'll start with a presentation on improving natural disaster resiliency efforts. Several states, including my home state of Louisiana, have enacted laws to encourage homeowners to take steps to strengthen their homes by providing them with insurance discounts. Certain standards are met. The laws do vary in terms of methods of encouragement. Some states require the insurer to issue a premium discount if certain standards are met, while others, including my home state of Louisiana, make the discount voluntary. Louisiana also has a program that grants homeowners funding to fortify their homes' roofs to certain standards, and I think the commission will be able to speak on that. We're doing some other things to even strengthen that as well. You can view these different types of laws in your binders starting on page 200, as well as on the website and the app. Now, I will say it's interesting that NCOIL did discuss this model law similar to Oklahoma's law, but that proposal was ultimately withdrawn as a consensus could not be reached. But now, with the unfortunate increase in natural disasters, this is a very timely topic, and I'm glad NCOIL is discussing it again. Before we go any further, I'm going to turn things over to Utah Representative Jim Dunnigan, who would like to make some brief remarks.
Thank you, Mr. Chairman. I'll be very brief. I'd just like to say that being from Utah, which is a state that's seen an increasing amount of wildfires, I'm very interested in the type of policies that you just discussed, and I'm looking forward to seeing what other states are doing and learning from that. And I'd be interested in perhaps developing an NCOIL model law that adopts one of the state's approaches so that we can help the states throughout the country. Thank you, Mr. Chairman.
Thank you, Representative. All right, with us today we have Roy Wright, President and CEO of the Insurance Institute for Business and Home Safety, along with my commissioner, Commissioner Jim Donlin, Insurance Commissioner from Louisiana. And both of them will speak on this resiliency model. So with that being said, Roy, you can start with your presentation.
Good morning, and thank you for inviting us to be here today. It's good to be back with Mr. Jordan again, who was out to visit us at IBHS. IBHS, the Insurance Institute for Business and Home Safety, is a 501c3 nonprofit that was designed and is funded by the insurance industry to really crash test buildings and understand how they perform. This is our facility in South Carolina where we have the ability to do everything at full scale and subject it to winds up to Category 4, both on commercial as well as what we can see play out in both tornadoes and hurricanes. When you see roofs pop off of homes and the kind of devastation that does, we're the only place that can test against wildfire embers at full scale. They're at our facility and understand how that plays, as well as water intrusion pieces that play. And again, we take real events and play them in that space. We also do quite a bit of work on hail and how that is subjected, testing various materials that are put onto homes and structures. Not only is that done at the lab, it's also done in the field where we deploy teams, whether that's in severe convective storms, looking at the impacts of hail. Obviously, that drives quite a bit of roof damage, as well as what we would see post-event on hurricanes and tornadoes, as well as wildfires. Again, it has to be that place where the science that can play out in the lab meets reality in the field. We have to keep building those bridges. Specifically, we were charged to address 4 specific hazards: wind, rain, hail, and wildfire. And as I mentioned earlier, we somewhat casually say we crash test buildings, not dissimilar to how the sister organization, the Insurance Institute for Highway Safety, addresses crash testing cars. In order to do that, it needs to be done at full scale and subjecting it to the kinds of things that Mother Nature uniquely can do. As Chairman Jordan said right at the top here, disasters and their impact continue to have a larger and larger impact on this. This billion-dollar weather event, most of the $1 billion is attributed back to what is the insurable loss side of the equation that is then met by the uninsured public infrastructure pieces that FEMA continues to pay for. For someone like myself, this has really become a full employment kind of piece, because we look at this, and as the gentleman from Utah was mentioning, we see this all across the country. We see this wildfires in the west. We see severe convective storms, tornadoes, and other kind of straight-line derechos that play across the Midwest and the east. We look at the impact of hurricanes that work not just the Gulf Coast, but all the way up the East Coast. I'm going to turn to the particular pieces here in a moment related to individual elements and how those ultimately play into the insurance world, but I want to start with one key element, because there is a single piece of legislation that matters more than anything else related to resilience in the states of this country, and it deals with how we approach building codes. Building codes, these states that have adopted them fundamentally change the outcomes of disasters. So those more intense, bright blue ones have statewide enforced codes. You have that dull kind of piece where they adopted an aspiration, but they have no enforcement. It is simply guidance that is available. And then we have a set of states that have nothing. So you can find those bright blue places. I apologize, a little bit fades in the lights here, but on the west coast of the United States, along with Utah and New Mexico, we go up to Wisconsin. In the Gulf Coast, we see Louisiana and Florida, and then some pieces that play in the mid-Atlantic. You would say, okay, well, that must be where the disasters play out. That's why they're focused on what does it mean to build to withstand what Mother Nature can send our way. So going back to 1950, here's your hurricanes, there's your tornadoes, there are your catastrophic wildfires. Unfortunately, there is not a correlation between the places where we see these disasters play and the states that are leading by using the very simple, straightforward science that goes into building codes. So, understanding that that's the best answer, we then need to turn to what do we do when we have the absence of strong modern codes and how we supplement that work. And that really has become the piece that we have focused on to apply the science through a series of pieces that we have done at IBHS related to hail and the products that can withstand the higher end hail, what we do in high wind events, in the places where that can be subjected to with a program we call Fortified, and then on the wildfire side, how we prepare for this piece. First on hail. Hail accounts for 60 to 80% of the losses that we see from severe thunderstorms across the country. And so we have spent an incredible amount of time and effort working on this. This is not one that is actually a life safety hazard, but clearly it drives more than $10 billion in insurance claims, insured losses in any given year. And so we go through and we study the very specific elements related to products that are there, some of which are impact rated and say, oh, this will withstand what happens on the hail side of the equation. We were drawn to this because there are a good number of states that have mandatory discounts tied to these hail-related elements. I know you can't see all the details of this from across the room, but I'll point to you that there are 3 different dimensions on the right side and the overall rating that sits there on the left. One gets a excellent green at the top, and there were those that have the marginal and poor performances that are there, which is to say they could not withstand the very things that they were being sold saying they would withstand. By publishing this, we began to see changes in the marketplace. Products were pooled and no longer sold in distribution. New products were put into the marketplace, and so I show you the examples that are here where all but one of these products now meets the good side of the equation. Simply shining the lights on it is there. But knowing that we're talking about the point by which direct price consideration needs to be put into place, we must be careful. In this instance, an impact-rated product was the one that was highlighted. It says, if you do this, well, then there's going to be a price consideration. Except the product didn't actually do anything. At which point there's not an underwriting basis or an actuarial basis by which you can have that element. We're going to turn to the win side. So Fortified Home, this is a program that goes back really over the last 15 years. We don't have a lot of time this morning, so I will look at some pieces. There are fortified gold and silver elements that are done at the point of new construction, which really says the entire structure will be able to withstand the winds that come, those Category 3 hurricane winds that would come. We look at things related to doors and shutters and openings, as well as how the entire building ties together. But I want to focus this morning on fortified roof because it's the one element you can do from a retrofit perspective on an existing home. And that's what's more broadly going to be available for folks. The fortified roof has three elements that are required. The first one deals with how the boards underneath are nailed down with ring shank nails so that they will not rip up when the high winds come. Secondly, you need to seal the roof deck. So for each one of those 4x8 wooden sheets that are there, on a really bad day, we are going to lose the shingles, at which point we have water. Water goes between those cracks and just fills up like bathtubs. When you go from a loss of roof cover to water intrusion, we see the increase in claim severity go up 3 to 5%. 3 to 5 times the size of it, not 3 to 5%. And then how do you lock in the edges so that you're less likely to see those pieces work? So, how does this play? In Alabama, it was Hurricane Ivan in 2004 that was the catalyst for so much of their change. They had Ivan, Dennis, and Katrina. They had more than $3 billion worth of loss. And so advocates in the insurance community, local leaders, as well as the state, developed a program related to Fortified that plays in this space. It is multi-pronged. I'm going to show you some contrasts here in a moment. Yes, there is pricing consideration that is in play. And the local building industry began to make this a default in everything they did in terms of new homes. The local counties adopted these pieces into code. And there was a grant program for those in greatest need. Doing any one of those without the other would not produce the same outcome that we saw. So quickly look at the Alabama piece. You go back to 2006. The lawmakers saw a path that is there. At first, the discounts were just inside the wind pool, the AIUA, side of the equation in 2008. You then begin to see those pieces play. You can see some designation counts that were going. Habitat for Humanity did some initial work in this pace, and then it ended up in the Coastal Supplement for Building Code Perspectives in 2012. It keeps moving, and then by the time in 2015, they added a grant program that laid. Prior to that point, there were mandated discounts if the action had taken place. And there were still less than 500 designations. That grant program gets laid into place, and you begin to see the movement that now works by which they are approaching 40,000 of these designations in the state of Alabama. It was that collective sense that is there. I'll look just at the southeast on this. We'll look at that number that will come up here in a second here in terms of where Alabama is at 36,000 designations today. North Carolina, more than 6,000. And there are now some programs that are beginning, and we'll hear from the commissioner and others in terms of work that is looking to see this advance in some other states. When we have those elements in place and they lean in, we see that it collectively works. We'll keep showing you the fortified house versus the kind of losses you would see in other dimensions. This one right here is a habitat home. This is in a moderate income neighborhood. This is right after Hurricane Sally. I was in a vehicle with a reporter, and we were driving around, and she said, well, which ones of these are fortified roofs? And I said, I've color-coded them for you. Now, this was early in COVID, so we're all wearing masks, at which point you can't quite read the faces of what's going on. She said, what do you mean? I said, the ones with blue tarps, yeah, they're not fortified. It was that clear, right? So it's not just a good idea that we talk about. We've then gone and looked at the research in terms of, in both North Carolina and Alabama, how much difference does it make? We see claims reduction as well as severity in both the elements we saw in Sally as well as the North Carolina, which has actually seen 4 events come through on that side of the equation. It's not just for homeowners. It can help renters as well. Fortified multifamily is beginning to gain momentum in this space. We've been working with the Louisiana Office of Community Development, and we're really encouraged to see how they are bringing both federal dollars and state pieces together. This program's just been around for a few months, and we're already seeing the impact that it has. There are 313 families already in that space, another 2,400 families that are headed towards some pieces that are there. I want to look at this particular small little development for multifamily that was in Lockport, Louisiana. It was just finishing up construction as Ida made a direct hit. The eye of the storm went over this community. And as we watch these pieces, the highest end of the winds, 135 miles, only one of those buildings experienced any damage, and it lost a few pieces of siding. This was workforce housing. After the event, this was the only viable workforce housing within 50 miles. It could withstand the event that is there. And I think this is what's so important. We're not going to stop the disasters from coming through. The real key is, can we limit its damage and make sure that after folks evacuate, they have a place to go back home. When they go back home, they go back to school, they go back to work, and the economy can move through. This is not just in places like Louisiana. We're seeing work in Iowa. We're seeing leadership coming out of the Federal Home Loan Bank in Dallas. Connecticut Housing Finance Authority has leaned into this space. It's requiring nudges coming from all of those elements. Let's turn to wildfire. You look at kind of the intensity that plays out now, and we see what happens when a fire gets to one house and how it begins to move. This is in Colorado, where we see these pieces play, and we see the elements that we look at our facility about the kind of things that happen on the wildfire side of the equation. We're seeing more and more and more of these play out. Unlike other perils, wildfire risk is highly intertwined with those living near you. When a flood comes in, it dissipates as it hits more structures. As a wind event comes through, if your home is well built and mitigated, there may be some debris that moves around, but you can be strong while your neighbor is weak. In wildfire, this is not true. The structure becomes more fuel. Once it burns, it begins to promulgate and move this kinds of pieces. There's no other natural disasters by which, when it hits the built environment, it makes it worse. the way that we see play in this place. And so it really requires a system of pieces. We need to incentivize individual homeowners to do the right things and businesses, but you then have to make sure you're putting the nudges in place at the neighborhood as well as at the community scale. This is so true because you can perfectly mitigate your parcel and your next door neighbor who has excess material there that is welcoming to those embers. Well, once they're burning, if you're in a suburban context, whatever you've done is insufficient. The fire's coming your way. Similar to Fortified, we've put the science behind wildfire into something we call the Wildfire Prepared Home. There's two levels of it. There's the base and then the plus. At the base level of it, you have to address the roof. It's the largest kind of place that can accomplish those embers. And again, those embers regularly pick up and fly a half mile away from the place by which they originate. Occasionally, we'll see it go as far as 2 miles away. The good news is that most Americans have Class A roofs. Already, the asphalt shingles are a Class A roof, and so they've already met that dimension. There's some building features, including the vents that let you into the attic and the undercrawl space. The biggest element is defensible space, those areas closest to the structure. This has been work in combination with CAL FIRE and the National Fire Protection Association, as well as NIST and other academics. We talk at Zone 0, it's the 5 feet closest to your house. Nothing combustible. Think about the normal American landscaping, and you put hedges and all kinds of bushes right up close to the house. Well, in wildfire-prone areas, we need to move that stuff 5 feet away. We need lean and green 5 to 30 feet, but the first 5 feet, you need to make sure that when the embers come and land, they extinguish. They don't actually ignite the structure that is there. We have elements in place. California has some pieces they've put in place through regulation. The wildfire prepared designation is one way that folks can meet those as it gets implemented later on in 23 and into 24. But it has to be collective in this space. So we go to a place like Paradise, California, that experienced the catastrophic Camp Fire. And by catastrophic, they lost 19,000 structures. 90% of the structures in that community were entirely destroyed. And they have leaned in that space and says, okay, as we rebuild, we need to put the right code pieces in place to make sure that people can withstand what comes their way. As I wrap up, Mr. Chairman, I think that while insurers all approach pricing and underwriting differently, certain basic principles underlie the insurance industry generally. One of them is that price follows risk. Generally speaking, as risk reduces, so do the prices. And yet the converse is not also true. Risk does not necessarily follow the price. As we look at different regulatory and incentive programs around the country, discounts alone, whether they're mandatory or otherwise, are not sufficient to drive people to reduce their risk. Remember, I showed you Georgia. The Georgia Underwriters Association offers a mitigation discount if they have fortified designations. There is not a single designation in Georgia. Oklahoma requires discounts for fortified designations without taking into consideration other policy measures to reduce risk. There are only 18 designations in the state. Some states require discounts for a whole laundry list of mitigation actions. And this is really the worst outcome because it becomes a market intervention without verifiable risk reduction. And frankly, it confuses consumers because they look at a menu and go, I'm going to choose 2 of these things, and there's an artificiality that is brought there. We've got to make sure that that science hits that place and fundamentally do it in a way that reduces the risk. And as that risk is reduced, the price elements will follow. It's what we have seen in Alabama, and I know momentarily Commissioner Donnellan will speak. I think as they're looking at the program in Louisiana, they're following this kind of model that says it requires more than just one policy lever in order to accomplish the outcome. So with that, Mr. Chairman, I'll give back my time. Thank you.
All right, thank you, Mr. Wright. And again, we'll hold questions until the end. Commissioner Downer.
Thank you very much, Mr. Chairman. Good to see you again in a different forum. See you next week again. Anyhow, thank you for the invitation. It's always a pleasure for me to have the opportunity to visit with NCOIL on behalf of my state and what we're about, but also on behalf of the NAIC, where we had a breakfast dialogue with your leadership this morning that commented on the excellent relationship that has been built between the NAIC and NCOIL, which I really, really think is beneficial to what I try to do back home. As you know, Louisiana is the bullseye. My chief actuary says that by on a per capita basis, we have been hit by landfall, by hurricanes over the past 100 years, 4 times more than Florida and 4 times more than Texas, though they have much larger coastal exposure than we do. As such, we have unfortunately developed some expertise in this area. And following our second worst hurricane event that hit our state last year before last, Hurricane Ida, a year and a half ago, that generated 800,000 claims, along with the year before Laura, Delta, and Zeta, over a 13-month period of time, and a total of $24 billion in insured losses paid by private insurers as a result of those 2 hurricanes. In our session last year, with Chairman Jordan, Vice Chair of our House Insurance Committee, we did a number of Band-Aids, I refer to them, to address what lessons learned in the aftermath of particularly the most recent spate of hurricanes. Laura hit Lake Charles a year and a half ago with 150-mile-an-hour winds. And a year and a day later, Ida hit Port Fourchon in the center of our coast with similar 150-mile-an-hour winds. The Weather Service, bless their hearts, said that those were the second most powerful hurricanes to ever hit Louisiana, pointing to what I had never heard of before, the last island hurricane of 1856. I've asked, how did they measure back in 1856? And it's by digging up residue from 100-plus years ago. Whatever. That was a Category 5. Category 4 is a plenty bad enough. We don't have to corroborate what the Weather Service says happened 150 years ago. But in the last year, we went to the legislature, our department did, and with their cooperation and, frankly, action, we passed a handful of bills that I'd like to go over with you quickly as part of my presentation. Our Senate Bill 264, and Senator Mills was instrumental in helping us do this without objection, which we copied from the state of Florida, because we had a spate of insolvencies in the aftermath of those 2 hurricane seasons. 3 of those companies, 3 of the 9 that failed, were domiciled in our state, and failed not because of Laura, Delta, and Zeta, but because of Ida a year later. The next 5 were domiciled in Florida, but had done a lot of business, property insurance business, in other coastal states, to include South Carolina, Louisiana, and Texas, and impacted us dramatically, myself included, as a policyholder from one of those Florida-based companies for the past 10 years, with a savings from that company on my home throughout that period of time of $600 a month on identical coverage versus the big national company that I had been insured by until I switched to Southern Fidelity. But what we learned in the aftermath of those failures is that the number one reason for the failure was the ownership going cheap, if you will, and not buying adequate reinsurance for the book of business and exposure that they took on. Florida had picked up on that 5 years earlier and had raised their minimum capital and surplus from $2 million to $15 million. And we, last year, raised ours from $3 million to $10 million. Not going to solve the problem, because typically those failed companies left behind for our guarantee fund $100 million of unpaid claims that the taxpayers ultimately will pick up over the next 10 years. But what we hope and expect that $10 million of capital and surplus requirement will do is make those owners more conservative, more prudent, more cautious when they go to the reinsurance marketplace, because we are dependent on those small regional carriers. In fact, my wife, I remember well, now 12 years ago, when we switched from our national carrier to that small company, she tells me, well, that's great, Jim, we're going to save $600 a month, but I never heard of Southern Fidelity. Are they okay? And I responded to her nickname, give me a break, Mops. That's what I do every day. I'm not about to buy a policy from a company I'm going to put out of business shortly. And her typical answer was, I guess not, and we made the change. The point being, though, that we, with our exposure, need these small regional carriers. For the most part, the big national carriers have retreated from coastal exposure, not just in our state. I dare say in the aftermath of Katrina, probably more politely exited our state than they did others. There's some statutory aspects that impact that as well, but our workforce, our population needs those small regional carriers, and the only way they can take on that exposure, and 30 came to our state since Katrina, and only 3 of ours failed out of those 30. But the only way they can effectively take on that exposure is to reinsure themselves up to their chin for that risk. And they do that, and they, for the most part, do it successfully. But those 9 that failed last year had a common thread of inadequate reinsurance for the risk they took on. We think having $10 million instead of what was actually $5 million on the table when they go to the reinsurance market to protect themselves and their policyholders will result in them being more prudent in that aspect of their business. January 1st, 2 months ago, our statewide building code adopted in the aftermath of Hurricanes Katrina and Rita, and it survived the legislative process because of then Governor Blanco putting up $20 million of her CDBG money for assisting the half of our parishes, as we call them, that did not have inspection services, permitting services, nor the money to start up those facilities in those parishes that didn't have a building code. And that money survived the attempt the next year to shoot a giant loophole into our new statewide building code adopted in a special session right after Katrina and Rita in 2005. That loophole said that if a contractor self-certified that he had built to the new statewide building code, it was good to go. And needless to say, that would not have worked. We prevailed in the 105-member House by 1 vote in defeating that provision a year after we had adopted our statewide building code. The latest update was done January 1 of this year. It made up for pausing the every 3-year international building code standard update required. Because of the pandemic, our state had paused that update and then met January 1, a second 3-year update requirement, did both at the same time so that we are on schedule to maintain the standard of the International Building Code that we committed to when we passed our building code in 2005. A big, big benefit to our improvement. In fact, Fortify, that Roy was talking about before, with the upgrade to our building code is now 95% of the requirements of Fortify. And that's a huge improvement to the insurability of our state. Senate Bill 412 provided and recreated, the Louisiana Incentive Program, offering grants to companies to come write business with requirements for the amount of writing, the solvency requirements, the monitoring, the staying on the risk for a minimum of 5 years, doing 50% as a minimum in South Louisiana. And yesterday was the last day and closed. I almost missed my part on the dialogue with the commissioners yesterday because I was on the phone back home learning of the latest of the 9 companies who have come to our state asking for $61 million of grants, which is limited to $45 million by the appropriation that we got earlier this year in a special session. But that program was very instrumental in our recovery of our market after Katrina and Rita, and will be again with this recreation of that program that has exceeded interest, has exceeded even the monies that are available for the companies wanting to participate. Senate Bill 198 is what we've commonly referred to as our 3-adjuster rule, and that one I copied from California, who did it several years ago in the aftermath of wildfires, etc., where they were struggling with adjusters being churning and turning over, as we experienced in the aftermath of Laura and the storms following it. At the 3rd adjuster, within a 6-month period of time, the company is required to provide an update in writing or electronically to their policyholder of the status of their claim, provide a primary contact person to that policyholder, and a summary of where their claim stands and what it's lacking in order to be successfully concluded. It has worked in California. Now, they didn't have 800,000 claims as we did. Roy said 90,000 in Paradise, which is a big event by anybody's standards. But we think we can make this work, hopefully without a pandemic, to prevent churning of adjusters in the next sure-to-happen catastrophic event. Senate Bill 163 requires specific disclosure for catastrophic claims process to include, and we have adopted it, frankly, largely based upon what the NFIP provides when they, a very helpful, handy consumer how to process a claim information booklet. And we have copied it and issued it to the companies to use in every homeowner's policy that is sold. Explaining things like the supplemental claims process, which nobody knows about back in our state, actual cash value versus replacement cost, which very few know about back in our state, what is necessary to document a claim, and how to file a complaint. 800,000 claims generated 8,000 formal complaints to our department over those 4 hurricane events. House Bill 521, also a good lesson learned, requires the companies to provide to us at the department before each year's hurricane season a catastrophic response plan, to include, and most important, to include the list of their contract adjusters that each of the companies has contracted with to adjust claims. These small companies, reinsured up to their chins, doing exposure on coastal states, don't have the army of adjusters that the state farms in all states have all across America to reassign to the aftermath of a disaster. So we want to know how the small companies are preparing to handle catastrophic events and be able to compare what one is doing versus the others to know if, in fact, they do have adequate resources available. And, of course, the primary focus of this year's upcoming session, House Bill 612, created the Louisiana Fortify Homes program to provide grants to homeowners who will either retrofit or build anew to Fortify standards. We're hoping to get to that 35,000 level like Alabama. This bill is verbatim, and the reg we've promulgated to implement it verbatim what is in place in Alabama, which, as Roy mentioned, started in Baldwin and Mobile counties and has now spread to Montgomery and Birmingham in the center of the state, with over 35,000 homes built to that standard. With those things said, now I'm going to turn to my script and talk. Nope, I'm not going to get to talk about the NAIC.
No, well, I will tell you, I hate to do this to my home commissioner, but we are on a strict time schedule.
Got it.
And so I'll give you 1 minute if you want to talk about that, and then we have to move on to Mr. DeCampos.
I'm Vice Chair of the Climate Risk and Resiliency Task Force, which is also generating the technology work stream thereof, which I'm the chair of, and the pre-disaster mitigation work stream to educate, bring awareness to coverage gaps and pre-disaster mitigation measures and resources, and incentivize insurer recognition of enhanced building codes in underwriting and rating. And lastly, the NAIC Catastrophe Modeling Center of Excellence that just hosted us Southeast Zone commissioners in Miami at Florida International University, the home to the International Hurricane Center, with CAT model instruction and presentations made over a 2-day period of time that I will tell you is the best NAIC meeting and service that I have seen in my 16 years. It's really going to be helpful to us in particular, well, not just coastal states, but earthquake states, wildfire states, all catastrophes. The Center of Excellence will provide the resource necessary for us to be able to price and quantify the risk and the best approach to addressing those risks. Thank you, Mr. Chairman.
Thank you, Commissioner. Do we have any questions? All right, Senator Hill, one.
Okay, thank you, Mr. Chair. My question to this is, I know it reduces the insurance cost. Y'all said that. How much percentage-wise does it increase the cost to build a project? Because I know there's got to be some cost increase. I want to see if I can live long enough to make that up.
And that's the key issue. Retrofitting requires a new roof. You got to take the old roof off and do a whole new roof. And the issue in Alabama was initially, do we just pay the $2,500, $3,000 difference in a fortified roof versus a typical roof? Or do we give a $10,000 grant to incentivize folks to take the other roof off and replace it with fortified, which really the difference in a new roof is just $3,000. But the cost of the total roof, taking it off and putting it back, as I did after Ida, is about $20,000 typically. So, but the difference in new construction costs, Roy, correct me if I'm wrong, $3,000?
Yeah, I think that at the point of new construction, these things tend to add only a 2 to 3% cost to the overall. On the retrofit side for the roof, it has to be coincident with the replacement of the roof. And the incremental piece, they're allowing up to $3,000 in the Alabama space, in both Alabama and I think in Louisiana. We often see that the increment actually is less than that amount, but it really is the price to put a new roof on that. A little more expensive in Louisiana than it might be in some other places, as with the size of your roof.
All right, thank you. Look, we're going to stop with the question. Well, go ahead, Carl. Briefly.
Thank you, Mr. Chairman. Thank you for being here. Thank you, Commissioner, for being here. And I know that you work well with my commissioner in South Carolina, Commissioner Farmer. But did I hear you say that you took out a policy with Fidelity? Southern Fidelity? Okay, and I'm in Georgetown in the Low Country. They dropped us in South Carolina.
They actually went insolvent. That's why you were dropped. Me
Okay.
too. Me
Okay.
too.
All right.
I had to revert back to my Army days and go back to USAA when Southern Fidelity failed.
Okay, all right. Thank you, sir.
All right. I would tell anybody, I'd encourage anybody, as someone who just recently visited IBHS, if you ever get an opportunity to take that tour to South Carolina and see the great work that they're doing, certainly take that opportunity to do that. All right. I think this is an issue that we're going to continue to discuss. Resiliency is a big issue, and so we'll be discussing it in future NCOIL meetings. So I want to thank everyone for that. All right. Next we have, excuse me, we have presentation related to catalytic converter theft, and we have Eric DeCampos with the National Insurance Crime Bureau. And before we hear from Eric, I'll just note that I think this is an issue that's becoming very prevalent, and I can tell you in Louisiana we've had lots of thefts of catalytic converters, so I know it's going on just not there but across the country. And hopefully we'll have a step forward with some model legislation for states to follow with. But for today, we'll hear from Eric and determine how to best proceed, and we'll hold questions until we're finished. Eric, I'm going to just tell you, just for the sake of time, I'm trying to limit you to 10 to 15 minutes.
Thank you, Mr. Chairman. I will be concise. And thank you, the committee, for allowing me to present on this issue today. I'd like to begin by just summarizing the threat. So we're talking about catalytic converters. They're exhaust emission control devices designed to reduce emissions. They're located underneath your vehicles. And since 2019, we've seen thefts related to these devices skyrocket. And there's both a consumer and an insurer impact to this. For consumers, it's a violation of their personal property, their safety. It's a disruption of their daily life. It's a loss of their vehicle during the repair process. For insurers, it's the cost of replacement. It's the repair costs associated with incidental damage done to the vehicles. These thieves are not exactly surgical when they're cutting these devices out from underneath your cars. But moving on to this, it's important to look at what's driving these thefts. And I'd like to begin by talking about the underlying impact of market forces, specifically the prices of precious metals. Catalytic converters have trace amounts of rhodium, platinum, and palladium. And since 2018, we've seen these prices increase, and since COVID-19, they skyrocketed. You can see the price of rhodium increased all the way up to over $18,000 per ounce. That's per ounce in 2021. And so market shocks cause disruptions in the supply chain, which ultimately results in a used attached catalytic converter being worth several hundreds of dollars on secondary and black markets. And so what does that mean for thefts? Well, since 2018, we're seeing thefts either double or quadruple every year from 2018 to 2022. And NICB is still working on data for 2022, but for Q1 and Q2, which we have so far, it already surpasses the halfway mark for 2021. And this is all based on claims data submitted to NICB from our member insurers. And also on the screen here, you can see a bar graph outlining the top 5 states for catalytic converter thefts. We have California, Texas, Minnesota, North Carolina, and Washington State. And you'll notice that those theft numbers are pretty similar to what we're seeing at the national level. With increased thefts comes second-order effects. And what that means is violence that's inflicted on innocent consumers, bystanders. In fact, there's a famous case out of Texas of an off-duty Harris County sheriff's deputy who was killed trying to prevent a catalytic converter theft from happening at a shopping center. And unfortunately, when folks are at the wrong place at the wrong time, or even if they decide to step in to prevent the theft from happening, that can result in serious bodily harm, serious injury, and unfortunately in certain cases, in death as well. There's also a financial impact, specifically to companies that have large commercial fleets. For example, Amazon. If Amazon parks their delivery trucks in a concentrated area, that makes for an easy mark or an easy target for catalytic converter thieves who can swoop in, steal multiple converters, all within a short amount of time. We're also seeing thieves becoming more organized, with criminal rings stretching multiple states. In fact, there's a case that the DOJ is looking on forfeitures of over $500 million related to a criminal ring stretching from California to New Jersey, and it includes states listed in that top 5 list that I previously mentioned. So how are states responding to this? Well, before 2020, 35 states already had some form of laws in the books for scrap metal. And that's because scrap metal yards, recyclers, processors, they're usually the ones who purchase used attached catalytic converters because they have the capability to extract those precious metals and recycle them into new products. In 2019, we started seeing an uptick in legislation being introduced that was focused specifically on catalytic converter thefts. So you've got, just to summarize here, increased metal prices, increased thefts, and now we're seeing more bills being introduced to address this threat. From 2020, we saw 12 bills introduced. In 2021, that skyrocketed to 64, and then that doubled again in 2022. And when we're looking at the bills being introduced, there are 4 themes here. Scrapyard regulations, so some examples of that are prohibiting cash transactions or making sure that transactions take place at a fixed business location. Buyer and seller restrictions, so we're specifying who can buy and sell a used attached catalytic converter. In some states, that's restricted to regulated entities, and others, you, me, the commissioner here on my right, can sell a used attached catalytic converter as long as we have the documentation to show that we lawfully own that device. The third theme here is a presumption of guilt. That is something that we've seen introduced in a couple of jurisdictions. What that means is if I'm driving around with 10 catalytic converters in my trunk and I don't have documentation to show that I own them, it can be presumed that they're stolen. This is a tool for law enforcement to help stem the rise in catalytic converter thefts. And then finally, and perhaps most importantly, new criminal statutes. Unfortunately, catalytic converter theft generally falls under a state's theft statutes, which are tied to the dollar amount of the item that's stolen. Well, that doesn't account for the total loss for catalytic converter thefts. And as I mentioned earlier, that includes the replacement costs, the incidental damage, the threat to consumers, the costs that insurers have to face. A new criminal statute would provide an account for the total loss associated with a catalytic converter theft. So NICB has been lobbying on this issue for several years now. We've lobbied on 55 bills, and we've seen 26 of them enacted. We've actually had the opportunity to work on some bill language with some sponsors in some jurisdictions. And just to give you an example of some of the bills that were recently enacted in the last couple of years, Senate Bill 70 in Louisiana is a good example of a bill that established a new criminal statute for catalytic converter thefts. In Mississippi, we have regulations on transactions for the purchasing and sale. And in Kentucky and Texas, bills were enacted that established record-keeping requirements for catalytic converter transactions. And this is important because it increases the paper trail and helps law enforcement with their investigations of thefts. So as we move on to 2023, I want to quickly shout out that QR code. If you scan that, you'll see the list of bills that NICB is tracking and engaging on for catalytic converter legislation introduced this year. And so far we're looking at 74 bills introduced, and there's a map there that shows the jurisdictions where they're being filed. I'm also happy to follow up after this with that QR code, so if folks are having a hard time scanning that. And just a couple examples of some bills that we're seeing introduced. Senate Bill 60 is a good example of a bill that establishes registration requirements for purchasing catalytic converters, prohibits cash transactions, and establishes those record-keeping requirements. We actually had the opportunity to testify in person in Georgia in support of this bill. And then in Virginia, we have Senate Bill 1135. This is a great example of a bill that raises the criminal penalties up to a felony for a catalytic converter theft. And then you'll also notice that presumption of guilt provision in there as well. So we're seeing all this legislation introduced at the state level. I'm happy to say that there's also legislation introduced at the federal level. NICB worked with Congressman Jim Baird on introducing the PART Act, the Preventing Auto Recycling Theft Act in 2022. We also had the opportunity to work with stakeholders in other industries. And you'll notice three themes. Some of them should sound familiar for what we're seeing at the state level: strengthening criminal laws and penalties, regulating catalytic converter purchases, but also this third item, VIN stamping. And what the federal bill does is it introduces a VIN stamping grant program to incentivize folks to bring in their vehicles so that way we can etch a serial number or a VIN number on their catalytic converters. And that does a couple of things. One, it deters criminals because now you have a catalytic converter that can be more easily tracked and flagged when they're trying to be sold at a secondary market. And then in addition to that, it also provides law enforcement with, yet again, more information to be able to not only investigate these thefts, but also potentially even recover the stolen items. And so what we're seeing at the state level and what we're seeing at the federal level, NICB is, and I'm happy to announce this, working on a model legislation on catalytic converter theft. And we're using some of the provisions that we're seeing at the state and federal level to establish a model bill that we're hoping to be able to have a more extended conversation in the near future on. But the four themes of this model bill that we're working on is A, establishing a new criminal statute, so finally making it a separate crime in statute. B, buyer and seller regulations. I won't rehash some of the themes, but there, one additional example in there is establishing a holding period for catalytic converter transactions. What that means is holding on to the consideration or to the payment for that transaction for a few days, and that's designed to deter those petty crooks from trying to make a quick buck off of a stolen catalytic converter. C, increase criminal penalties, so elevating these thefts up to at least a felony, and associated fines and terms of imprisonment. And then D, the VIN stamping program, establishing entities like local law enforcement agencies to be able to host these VIN stamping events and encouraging folks to get out there and get their catalytic converters stamped. And so with that, I want to thank everyone again for the opportunity to present on this issue, and I'm happy to answer any questions that anyone might have. Thank you.
All right. Thank you for the presentation. If we have a couple of questions, we'll entertain 2 questions. Representative.
As you know, we did pass legislation in Illinois, but I did have a question on your VIN stamping program. You know how we feel in Illinois about doing grants. I need a line item to help do that. But why couldn't the manufacturer just automatically stamp that VIN on there when they're building the car?
So we've had conversations with manufacturers. This topic did come up during discussions for the federal legislation. But right now, we want to focus it as a state issue and working it on encouraging folks to be able to work with their local law enforcement agencies and other stakeholders within the states to have their vehicles brought in and stamped at that point. So essentially making it a choice for them.
So what's the approximate cost per vehicle to have that done?
That is an excellent question. I'm happy to follow up with you after this in order to provide that information.
Entertain one more question that we have.
I'll talk really loud. What are the results of the states that have initiated these things? Are you seeing any examples?
So it's still very early, and there's a lot of variation that we're seeing state by state. However, what we are seeing is increased deterrence. What we are seeing is improvement in tools that's available to law enforcement and prosecutors to be able to try these theft cases. We're also seeing a lot of activity coming on with combating organized criminal rings, as you've seen, or as you may have seen on those slides, with what we're seeing not only at the DOJ, but also at the state level as well. So results are, we're starting to see some results, and there's a lot more to come as well, especially when we can start establishing some more uniform guidelines on legislation and providing the necessary tools that we need to combat this issue.
All right. Thank you.
Thank you.
I want to thank all of our speakers. These are issues that we'll continue to discuss in the future. If you have any questions, certainly you can reach out to me or the NCOIL staff, and we'll be happy to try to answer them for you. I'm going to ask the speakers to clear the table to make room for the next presentation, if you would. All right. Last on our agenda today is the consideration of the NCOIL Insurance Underwriting Transparency Model Act, sponsored by Representative Lehman, our immediate past president. As you likely know, Representative Lehman has been working very hard on this and working up until this very moment, as you see, on this issue. And I think we're finally at a point now where the model is ready for a vote. You can see the model on the website and the app in your binders on page 196. So before we hear from our speakers today, I'm going to turn it over to Representative Lehman for any comments.
Thank you, Mr. Chairman, and thank you for hopefully bringing an end to this process. I'm not going to go through the whole path that this thing has taken, but I will say this. On a point of kind of personal privilege here, looking around this table, I'm seeing a lot of new faces, and I think that is a fantastic advancement for NCOIL. So I do want to, for those who have not been a part of this process, just give you a brief background. So this was an issue that first presented itself probably in the last 5 to 6 years. We began to see more and more insurance companies moving to artificial intelligence and moving to new models of writing insurance. I had a bill actually in Indiana back in 2022. We pulled that bill and brought it to NCOIL, worked on that through 2022. And then at New Orleans, we said, let's try to find a solution. We filed a bill in Indiana, and that became the new model. There are some changes I'm going to walk through briefly, but I will say this. I think that what we've been hearing over the last several years and what we've been seeing at NCOIL has been that this is not a fad. This is not a trend. I refer to it kind of as this is the new MVR. This is the new clue. This is a new credit model. This is here to stay, and I think NCOIL needs to be the leader on getting our hands around the use of artificial intelligence and data. I said when I was in leadership at NCOIL is that, NCOIL's focus is to build the foundations. We do not narrow this down to the exact language as every state should pass. We build a good foundation and let the states add the trim and the color of the walls, et cetera. So I'm going to walk you through a little bit of some of the changes that have changed. There's been some key changes on this bill or this model from the time we started. I'm going to walk you through that. And Mr. Chairman, I do have a couple of things I think I would like to add to this as an amendment to be amended into this. And I'll cite those as I go through this, and then maybe we can keep track and then take those as one large amendment. Since the last time we met, we have removed declinations. We are saying that this applies to any homeowner or auto insurance policy that's currently in force at a renewal, et cetera. We changed adverse action to material change. It sounds generic, but it really is more of the true thing, and that is you're actually changing my policy. It can be interpreted as an adverse action, but it's really more of a material change. There was some concern on a couple of pieces that you might hear from the panelists dealing with non-renewal or cancellation or reductions in coverage, because currently in a lot of Indiana code, other states have pretty strict restrictions around what you have to disclose, non-renewal and cancellation. One of the things we want to be very clear of, we don't want to be duplicative. So we did put into here regarding those around the Federal Credit Reporting Act, saying that if you're already indicating someone for that, you don't have to do this as well. That may be in your state, an issue around reduction or non-renewal. And again, I'm going to leave it in the model because I do think that's something that you need to look at your state on a piece by piece. So I'm going to leave it in there for now. On the section regarding the key part of this is what you cannot, well, let me go back a second. On page 2, regarding the terms that does not include in this, and we put a list together over time, things like if it's insured initiated, if I add drivers, if I increase my coverage, if I do things that are going to actually increase my premium more than the filed rates of this in the state, then you do not have to disclose that. One thing, Mr. Chairman, I'd want to have some discussion around. I don't think at this time I'd put it in the model, but I think there needs to be some discussion around it is a lot of companies are doing homeowner inspections. We just saw a great presentation on Fortified. If they come out and they make changes to their policy based on those inspections, then I don't think this would apply. The concern I think I've heard from some is, companies could come out on a regular basis and continue to make changes and stay underneath that percentage. So at the present time, I think it's something you can discuss back in your states, but I do think if it'd be an annual inspection type of thing, maybe that would work versus, I can do 20 inspections and change every time and not hit that level. So that was a concern. So again, I think it's something we can discuss. A couple of drafting notes on this section is the application of declinations. As you know, we talked in New Orleans. There were some who felt like it really should belong in there. I'm modeling this more or less of what we were able to be successful with in Indiana. And in Indiana, that was not something we were going to be successful with, so it's not in the model. But again, that is something I think you can take up with your states. On the transparency requirements, we do say that you shall provide a written notice to the insured explaining those principal factors. And if you want more information, then they can provide you with a written request, and you can see the data in front of you. One change I would like to make, Mr. Chairman, on this is in that disclosure, we added language in the fall under the notification to a producer, and we have in there that the notification is through a written request submitted by in this case, the insured. It must be provided by first-class mail or electronic delivery as set forth in your state's code. I would like to add a D to that, and that is in notification to the agent that may be provided to the producer via the insurance portal for the producer's carrier. A lot of us, I'm an insurance carrier, a lot of us get our data not through so much an email or mail, but we get it through our portal that we get updated every day. So I would like to add that to the model around notification to the agent. The key portion of this bill, or this model, is all in the insurance requirement, transparency requirement, section F, dealing with the triggers. And what you have to do is you must be sufficiently clear to the insured and use language sufficiently specific indicating this. You must do that. You must include a description of the principal factors most heavily weighed. This model, from the time we began, has hinged on that sentence. We've gone from 5 points to 10 points to different numbers of data. I think what we ended up in Indiana was your state can set a number you want to set, but for the sake of the model, I think we're focusing so much on the most heavily weighed. We want to know what's moving the needle. So the key portion of that is the principal factors most heavily weighed. And one of the things, Mr. Chairman, I'd like to change as an amendment would be on number 3 of F. It says that they must be clear, they must give a description, and then it says there they may provide a point of contact. We want to be very clear that you must provide a point of contact. So if I send you that written notice, there has to be some data on there as to how I can contact you. I think that was always the intent, but I think it needs to be clear that you must have that point of contact on that. So I would like to change that from a may to a must. Again, from a drafting no standpoint, we have in here that you can, in your state, you can look at, there should be other factors, most of the factors, but again, the key here has always been those most heavily weighed. The rest of the model is pretty much a boilerplate, what you can't disclose, and that's already what you see there is already current Indiana code. And then we do put some provisions around the commissioner being able to set rules in this space. And then effective date can be when you feel like your state can implement this with some of the changes to those data models. The goal when we started this has always been, and I think I started the presentation 2 years ago with, I have to have a reason. I can't keep telling my clients, I don't know. As a professional agent, when people say, why did my rate change by 14%, I can't say, I don't know. I think this model starts us down that path. This is a good transparency and sets that foundation. And the public wants transparency. With lack of transparency comes mistrust. And so I think as we talked yesterday about what's happening with personal data, we're on the cusp of a lot of things around gathering, collecting, holding, and the use of personal data. I think this starts us in that vein, that narrow vein of insurance, and I'd be happy to answer questions and would ask your support of this model.
Thank you, Representative Lehman, and I know you've worked hard on this, but before we move forward and carry on that discussion, we're going to start with the speakers, and we're going to do it in this order, and speakers, I'm going to stay on track. We're going to limit you to 5 minutes. So we're going to start with Frank O'Brien with APCIA, John Schnauts with NAMIC, Wes Bissett from the Big I, and then Robert Harrell from the Consumer Federation of California. In that order, try to keep it to 5 minutes or less, please.
Thank you, Mr. Chairman. Frank O'Brien with the American Property Casualty Insurers Association. So this has been a long and painstaking process. And this document here represents a compromise. And there are some things in here that, frankly, our business people are going to find challenging to put in place. There are some things here which are probably good public policy. But I think at the end of the day, one of the things that Representative Lehman has pointed out is that this is a beginning. We are starting to get our arms around this whole transparency issue, getting our arms around different expectations. Some of the amendments that Representative Lehman has suggested we think are good ones. We still have remaining concerns with this, some of the language in this proposal. But on the other hand, one of the things I can say is that it has been an exhaustive, in some ways exhausting, 2-year effort on the part of the interaction. And there have been a lot of different viewpoints expressed, a lot of different changes. We appreciate the interaction that we have had with Representative Lehman and with others who have had a different point of view than the representative. This is probably about as good as it's going to get. So with that, I know that there are other issues and other concerns, and I think I'll leave my comments at that, and we'll move forward as the discussion goes. Thank you, Mr. Chairman.
Thank you. Mr. Snouts.
Thank you, Chairman Jordan, Representative Lehman, members of the committee. John Schnauts, National Association of Mutual Insurance Companies. Appreciate the chance to address you all on this today. Back at the November meeting in New Orleans, we had 3 major issues at that point that led us to oppose the model. I'm happy to report that 2 of those have been addressed fully. And that this model, I think it's safe to say, from our perspective, is much better than it was at any earlier stage. The position I think we find ourselves in today, given the significant changes that have been made and the understandable desire by Representative Lehman to move forward on this, is that we do not oppose NCOIL's adoption of the model. I do also think that as this goes forward and we see how this fits into the web of existing state laws that are out there on this subject, we might find ourselves even in a position to support some version of this concept. I will briefly touch on a couple of reasons why we don't find ourselves in the position to endorse it today. First, I mentioned we had 3 issues and that 2 of them had been resolved. The math suggests there's 1 remaining, and that is the language around the disclosure itself, what actually has to be disclosed. On that issue, the language that NAMIC's members preferred was based on something taken from the NCOIL credit model. As Representative Lehman alluded to, some of that language was taken, but the other language that was in the earlier version of the bill, minus the specific number of factors, is also still in the bill. And our members remain much more comfortable with the credit model framework for that, is for reasons I can go into if there are questions on that point. Second point, the experience since November, I think, at least for me, has been instructive in terms of what state law is already out there on this subject. Representative Lehman alluded to the existing Indiana law. I think that issue is going to be addressed in Indiana. And the issue here for us is one of the points, for example, on the FCRA provision that we have tried to make from the beginning is avoiding, I don't want to say duplicative notice, because if it was truly duplicative, you could just say, okay, well, you have to give the same notice twice. Is that really that big of a deal? It's really overlapping notices that say different things, that require different things. That we do not want in any state law anywhere, frankly. I think that's going to be fixed in his bill in Indiana, and we appreciate that. The approach that the model takes, though, as we read it, is sort of a layering approach. It basically says if there's existing law on this, this goes on top of that and both apply. And from our perspective, that's still problematic. Briefly, I will say in my home state of Texas, I will bashfully admit I didn't know this in November, but I've since found it out. We have an existing notice and reason, have to give a reason requirement on requests for cancellations and non-renewals already. If this bill was introduced there, I think we would be suggesting amending that statute or trying to align the two, but not just putting one on top of the other. And finally, sort of along the lines of that same point, back in November, I think the very first thing I said to the committee was that our main concern was value. It's not that this isn't doable, at least for large companies. It's what is the value balance of doing it? What's the value to the policyholder versus the cost to the company, which is ultimately going to be borne by all policyholders? I will say, I think, without betraying any secrets, the industry right now as a whole is extremely sensitive to cost increases, perhaps historically so. To give one example, there's a bill set for hearing in Texas next week. It's one of my ex-boss's bills, so that's always interesting, but that I'm going to oppose. All the bill does is increase the non-renewal notice time frame, not reasons, just the time frame. That sounds very simple. I can explain why it's more complicated than it sounds if you'd like. It's good practice for the hearing next week. But even something as simple as that is a concern to our members, I know, from the feedback I've received to them. And this model, for all its virtues, is exponentially more complicated than that. So I think that just provides some context to where we are. To end on, I think, a hopeful note, I do want to say we are really grateful for what Representative Lehman has done to this model. It is in a lot better shape. And I think, as Frank alluded to, and as Rep. Lehman did too, this is probably not the end of anything. This is probably part of an ongoing conversation, and we intend to remain part of it. Thank you. Happy to answer any questions when we get to that.
Thank you. All right, Mr. Bissett.
Mr. Chairman, good morning. I'm Wes Bissett, Senior Counsel at Government Affairs for the Independent Insurance Agents and Brokers of America, the Big I. I think you summed it up perfectly a few minutes ago when you said that this proposal is ready for a vote. And in the strongest possible terms, when you come to vote, we hope that vote will be a yes vote. I'd like to make 4 points with regard to this proposal. First, in our view, there is a clear and overdue need for this and value in doing this. As Representative Lehman said, the underwriting and rating process in personal lines in recent years has become increasingly complex. Insurers are using new types of data, complex models, analytics in ways that they've never done before. And those innovations are a positive, but one of the consequences of that is that the rating process is far less intuitive than it used to be, right? Not that long ago, it was pretty simple. If you had a spate of recent accidents, you could expect your rates to go up. If you added a teen driver to your auto policy, you could expect your rates to go up. But what we see today is that large increases are oftentimes counterintuitive. Consumers don't understand why they've had a 15% increase, and their agents can't explain it to them. And oftentimes when those agents go to the companies asking for an explanation, the company contacts that they have can't explain those either. And that's a frustrating outcome and respectfully not a good thing either. So what all this bill does at the end of the day, and it's not complex, it doesn't impose a lot of costs on companies, it merely requires companies to say to the consumer, if you have questions about a significant rate increase, you have the ability to ask for more basic information about that. That's all it does. There's also a need for this because individual states and the NAIC are beginning to act in this space. And some of those proposals are going far beyond the Lehman proposal that you have before you today. And some of those proposals are very troublesome and frankly unreasonable. What we believe should happen is that there ought to be a thoughtful, pragmatic solution to this issue that's frankly legislative based. We don't need unilateral regulator action in this area, and I think that the balance that's been achieved here is the appropriate one and one that ought to be acted on. Secondly, I'd say that this proposal is reasonable, very reasonable. It does strike a balance. There's nothing draconian in here or unreasonable. It simply brings some basic transparency to the process if you actually ask for it. In most cases, consumers probably won't ask for it. And so there's not this significant cost that maybe some have suggested. It only applies if you're non-renewed or if you get an individualized 10% rate increase or more. So not even 10% total, 10% above the base rate increase that would apply in a particular state. And there's lots of reasons why this is important and why there's value in this. Consumers ought to have a basic understanding of why their rates have increased, especially if that's a dramatic rate increase. And this would give them the ability to rectify any mistakes in the information that was used if it was incorrect or incomplete. So they can act to improve those outcomes. And frankly, it helps restore faith and trust in the insurance rate making process, something that and there are increasingly questions about that today. This would hopefully restore that faith and trust. So I appreciate the work that's gone into making this a reasonable and tailored proposal. Third, I'd say this is also not a novel or new concept. In the banking context, for many years, federal law in the form of the Equal Credit Opportunity Act and Regulation B has had a framework exactly like this. If you get denied a loan, the changes in a loan change, you have the ability to request this exact type of information. So there's a clear federal banking parallel. There's also an insurance parallel.
1 minute.
When insurers began using credit information 20 years ago, NCOIL adopted a comprehensive credit model, and one of the things in that said, if there's an adverse actions taken, you can get information about the reasons for that. So in the banking context, you can get this information. If insurers take an adverse action based on credit information, you can get sort of basic information about the reasons why. And all this does is kind of bring things up to date, given the new underwriting factors that exist. Finally, I'll say, even if you don't intend to bring this back to your state, you don't think it's necessary in your state, we would still urge you to offer a yes vote today. There is significant and sufficient interest among many states in this, and we need a thoughtful, pragmatic, narrowly tailored, legislative-based response for those policymakers that want to address this issue in their state. So, again, I appreciate the hard work that Representative Lehman, the NCOIL staff, my industry colleagues have put into this, and strongly urge you to provide a yes vote today. Thank you, Mr. Chairman.
Thank you. And again, we're going to hold questions to the end, so we'll go to Mr. Harrell.
Thank you very much, Mr. Chairman. My name is Robert Harrell. I'm the Executive Director of the Consumer Federation of California. I appreciate the invite by NCOIL and your committee. I'll be speaking this afternoon on a couple of items as well. I know one of the things that NCOIL tries to do is bring in some local regional folks, so let me just spend about 30 seconds on a little bit of California context, and then I'll pivot directly to the Model Act in front of us. In California, you have prior approval in the auto context and in the homeowner context. That's important. That's a major consumer reform that happened in 1988 by the vote of the people of the state of California. It was actually, there's a much longer story behind that. 5 initiatives on the same ballot at the same time, and the only one that was successful was the one that added that prior approval and also reduced rates in some cases. So there's a long history. There's been work done by other organizations about the savings to consumers pursuant to that. So that's part of the context. Secondly, to get a little more specific, and I appreciated the beginning of this session, Mr. Chairman, talking about some of the natural disasters and some of the work's been done, Commissioner Donlan and Louisiana and others. California will face earthquakes, obviously, different type of insurance. We faced, just recently, we've had a very wet winter. We faced a blizzard notification, which is exceedingly rare in California. And you've had some roofs collapse, for example, because of weight of snow, things like that, things that are not very common, especially since we have been in a multi-year drought and are now maybe, just maybe getting out of it. But the other thing I want to point out is in 2018, when I worked for the department, I worked for the California Department of Insurance for almost 6 years as a deputy commissioner. We sponsored a bill authored by then State Senator Ricardo Lara, now California's insurance commissioner, that did something very important. And that was it allowed the commissioner the authority after you have, for example, wildfire or some other disasters, particularly it's been used in the wildfire context, to identify by zip codes areas in which the insurers are not allowed for a year to decline to non-renew. That important buffer zone has been really critical when you think about the context of disasters, especially out here in California where you've had a lot of wildfire. Paradise came up, that whole town basically, you heard 90% was decimated. So that context I think is relevant to then pivoting to what Representative Lehman is trying to do here with this model. I'll be brief and pivot to some additional thoughts. In the model, and I have not been involved in a lengthy period of time in this, so I've come at it relatively new. In the model that is available, and I appreciate Representative Lehman's modifications with the agent notifications, things like that, there are some drafting notes. And generally speaking, I think the view of the Consumer Federation of California and the view of other consumer organizations would be give consumers actionable, understandable information when something happens. I think that's such a foundational principle here that ought to underlie everything that we do in this area. Explain to them, for example, while one of the cost limitations is that, well, a lot of people won't ask for the explanation. If the insurance company knows why you got denied, or I would add declinations as well. I know that that's an issue that had come up in some of the debate. I would add that. Why? Tell me why. Give consumers the information that they are so desperately seeking so that they can understand and act on it. I just think that's so fundamental to what we ought to be doing here. So the drafting notes I think are very helpful. This is a good first step, don't get me wrong. But I do think that what I sort of heard reading between the lines a little bit is that the insurance industry in your state reserves the right to oppose any bill that you propose in this area, and may well do so depending on what's going on. So you'll have to obviously fight those battles within your respective state legislatures, work with your respective commissioners.
1 minute.
Thank you. So make the explanation automatic. Don't force the consumer to have to ask, and this says in writing. Make it easy for them. A hyperlink, a form that they can just fill out to find out, or better yet, tell them. Tell them what you know. In California, we dealt with fire line scores and things like that, where some companies just automatically, if the number's the wrong number, you get declined. No explanation. We had literally state legislators get denied, and they couldn't find out. Legislators who were insurance agents. So the principal factors, I think, is important to be included in your respective states. Try to get more information out there. Retroactivity really isn't an issue here because these are policies that renew every 6 months or a year, so pretty quickly you get everyone up to speed. But happy to answer any questions, but that's our general sense. Good step in the right direction, but try to strengthen it so that consumers understand what's going on, give them actionable, reasonable, understandable information. Thank you.
Thank you. We'll entertain a couple of questions if we have any. Any questions? Assemblywoman Hunter.
Not necessarily a question, just a comment. I know we've been having this conversation for several years, and I don't remember what your name is, sir, the last person who just spoke, but I do think that it is important, especially bringing it back to the consumer level. I think a written request is something outside the scope of what many of my constituents would be doing, quite honestly. I do think that we've come a long way in this conversation for the past couple of years, and I appreciate the work. I think that if we were to bring this back to New York with this model, we would probably be adding a lot more stuff in there relative to not putting so much difficulty for a consumer to have to get that information. Insurance is very confusing and complex to many folks, and being able to, I think those words that you used were exactly right, actionable and understandable. I think that's something that we need to make sure that we're incorporating. So I appreciate those comments. Thank you.
Any other questions or comments? Representative Dunnigan.
Thank you. So I have a question for John. Wes mentions that it really doesn't require you to do much if the consumer doesn't ask for it. So what is your concern? I understand the concern about expenses, but do you see it that it does require you to do stuff if the consumer doesn't ask for it?
Sorry, thanks for the question. So the model goes two ways on that. The company can just provide the reason without waiting for a request, or it can wait for a request. It is true that the company could just say, well, if we don't get requests, we're not going to respond to them. From a company management perspective, though, they have to be prepared to do it. They have to have a process to do it. So they could do that two ways. They could say, well, it's too expensive. Our IT department says it'll cost however many dollars. We're just going to do it manually for requests. That's a little bit dicey because you don't know how many you're going to get, and any manual process is going to take a lot of time to comply with. So they're going to have a choice there. Do they program it, or do they take a chance that they don't get that many requests? But either way, there are issues to deal with there. It's not just, oh, well, it's on request, maybe we won't get any. You have to be prepared to comply with the law if and when you get requests. So.
Thank you. And I have a question for Representative Lehman. Thank you for your work on this. Seems to be one of the concerns is for the disclosure is not following the credit model. Is there a reason that you didn't follow the credit model disclosure and went a little bit different path?
Yeah, I think a lot of that was, I think the credit model, if you look at what that's based on, it's on one factor. I mean, there's many factors that go into the credit model, but it's purely around using that piece of credit as the factor. What we're seeing here is they're using multiple data points. And so I think they could be using social media data. They can be using buying habits. They can be using, obviously they'd be using driving habits. They formulate all that into this complex, we call it the black box, you might say. And what we're looking at is where the credit model may take in pieces of data, it sends out one piece. This is sending out multiple pieces of that data, which is why we started with a number of factors, because we want to make sure people are clear as to what's driving this, what's making this change. Because the other thing we like is we want people to be able to correct inaccurate data. So if I know what's driving this and you're more specific to those principal factors, I can maybe address those changes. That's why we didn't just mirror it exactly. We actually wanted to be a little bit broader.
One other question for you. Would you speak to layering? What if a state already has something in this? It doesn't sound like there's an exemption in the model for if it's already being done or something similar being done. So are you concerned about layering?
Yeah, and I think that's why I think you have to go state to state. Because I think the issue around even non-renewal and cancellations. John said he was surprised that, Texas has that. Well, Indiana's had it for decades, requiring if you send out a non-renewal notice, you have to be specific as to why you're non-renewing. You have to be specific to why you're canceling. Cancellations are very thin, and that is usually it's non-pay or material change in your exposure, whereas non-renewal can be for multiple reasons. And so it's still in here because I think if you don't address that in your state, you need to. You can do it through this, or you can do it through other sections of your code. So I think that from a duplicative standpoint is, John said not to use that word, but I would, and that is, I think what we don't want to do is if I have to notify you because of one factor, and it's clear why I'm doing this, and it's under either the credit scoring issue or under a non-renewal issue, if I'm already being very clear why I'm doing that, I've got to send that notice out, then you don't need to comply with this section of that code as well. So it would not be sending out two notices. Does that make sense?
Thank you.
Thank you. All right, last question, Senator Thies.
Thank you very much. Thank you, gentlemen, for presenting today. Coming from Michigan, where this particular market has gone through some dramatic turbulence of late, I'm concerned about injecting yet one more aspect into the equation that is going to be something that our insurers are going to end up having to try to figure out beyond all of this stuff. With the changes that we made legislatively and with the court cases that are still up in the air, has anybody done the math on what this might actually end up costing our insurers?
Mr. Chairman, if I may, I think I'm going to answer your question, or try to answer your question, but I'm also going to go beyond that just a little bit. This is going to be expensive to implement, and there are going to be significant operational hurdles. And that will obviously have to be put into the legislative mixmaster as this model or something based on it is put before the legislature. I'm going to borrow Mr. Harrell's words. This was a very thoughtful and engaged process, and there was a lot of consideration that went into the various things. We are trying to put in place something, or we came to a place where we thought we're trying to put in place something that will provide consumers with actionable information that they can use regarding their insurance policies and perhaps change things or do things differently in order to impact their rate. We're trying to also balance that with, as I mentioned, the very significant expense and operational concerns in terms of putting this in place. One of the things that we were concerned about, and there was a debate concerning whether to have this as an automatic type of thing that gets sent out to everybody. In some ways, for some companies, that might be easier for them to accomplish in their systems. But on the other hand, after all the GLB notices, it becomes white noise. So some of the drafting decisions and some of the policies in here, after extensive discussion, reflect some policy choices that you could make a credible argument for the other way around as well. I mean, for example, going back to Representative Lehman's amendment that was put in place just a few minutes ago concerning inspections. Yeah, I mean, you can make an argument about inspections and the impact of inspections. You know that an inspection is going to happen, and so you know that there could be something that would result from that inspection. So is there really a need to have a notice? Maybe yes, maybe no. I can tell you it's not going to be cost effective for any company to do multiple inspections on a property during the course of a year, or a lot of companies will do it every couple of years, stuff like that. So at the end of the day, this is a compromise with a capital C. There's a lot in here that we could live with. There's a lot of things that we think in here are going to be challenging for us. Similarly, from the other point of view, from a consumer protection point of view, you could go completely the other way, but we're trying to thread the needle on a practical solution. It's a long-winded answer to a very short question. I'm sorry about that.
We're going to let Mr. Harrell speak from the consumer side, and then we'll go to comments from Representative Lehman if he has any closing comments, and then we're going to have to take a vote.
I'll be much more brief. Insurers know when and why you're denied or non-renewed. So I think the cost will be a lot less than sometimes the sky is falling things that you sometimes hear. That's not to say that there won't be any cost. I am neither naive nor Pollyannish about that. The other thing I would just note is that carved out, and I don't mean this in a disrespectful way, carved out of this is anything that relates to, quote, an increase in the insurer's filed rate plan. Now, most states don't have prior approval. So if the insurer's filed rate plan, once it's finalized and is in place, that's exempted. You've just exempted out probably a big chunk of the people who should get this information and would want and need this information. I find it ironic that insurers are using a lot of big data and AI, including, as the sponsor just noted, social media data, other data. The files on consumers are extensive and, to be candid, a little bit scary. But when they're asked to tell you something that you could actually take action upon as a consumer, all of a sudden it's, oh my God, we can't do that, or it's going to be too expensive. So I would like to just put that in some perspective. Thank you for the question.
My last question, I'm sorry, I've got one quick follow-up. Any states that have implemented this, has there been any legal liability where the consumer disagreed with what it was that the insurer was informing them of and then turned around and sued as a result?
I think that would depend on whether you're in a mandatory issue situation or not. Off the top of my head, I know that in California, you don't have mandatory issue. And so what we've seen in the face of wildfires is insurers, as the WUI, Wildlife Urban Interface area, has been better known, insurers have pulled out of areas where they're worried about their risk profile. So I think mandatory issue has a lot to do with how that question gets answered. And to my knowledge, it's very rare to see mandatory issue anywhere in this country.
You can answer with a yes or no. Yes or no. Just if you know, fine. If you don't, yes or no. No explanation.
Well, this model hasn't been adopted anywhere.
Okay. So that'd be no. Thank you. All right. Representative Lehman, if you have any comments.
Thank you, Mr. Chairman. I know we're running late on time, so I just want to thank everybody for their input on this. A couple things I just want to bring up is that were brought up. I made some notes on. One is I think we give a lot of leeway to the Department of Insurance to promulgate rules. So one of the things you're going to be very clear on is I don't think you're going to have this, rogue switches one way or the other. I think the DOI is going to have a lot of say in that. And I don't think this is, again, this has not been implemented in any state. Indiana is the first state to really adopt something close to this. It's in the Senate now, and it's going to probably be changed, as I'm hearing. But I'd also say, the NCOIL passes models that we think are good longer term, and if it's doesn't fit your state right now, don't implement it in your state right now. But I think we have to get the template out there and have that discussion. To the issue of we're carving out a huge chunk of people from the filed rates, I'll use Indiana as an example. I would say over the last 5 years, our rates in Indiana have basically stayed fairly flat. We've gotten a percent or two increase here or there, but really it is a competitive market. We have a very competitive market. So my focus wasn't on, showing everything, but simply saying if you're going to be outside that competitive market with an individual, disclose. That's why it's the 10% above those filed rates. So I do think the market is responding to the competition. These are the outliers. And with that, I'd appreciate your support.
All right. Look, I'm going to make a few brief comments, but before I do that, I'm going to just remind you, we're going to have, I think, 2 amendments to vote on. So we're going to vote on the amendments first and then on the model with the amendments if they pass. Per the NCOIL bylaws, only members of the committee are allowed to vote. So if you're not a member of the committee, you won't be allowed to vote on it. That being said, let me just say this. I'm going to start by agreeing with Mr. O'Brien. I think this bill is a compromise with a big C. I want to thank Representative Lehman for all the hard work that he's done on it. Because I would tell you, I'm one that thinks it has been compromised on the other side. I certainly think it should apply to declinations as well. And let me just give some context to where we are on this. And it sort of disappoints me to hear some of the folks in the industry against this. But again, I won't let the perfect be the enemy of the good. May 25th, I think it was, 2020, was the death of George Floyd. And ironically, in Minneapolis, Minnesota, where our next meeting will be held. Under the leadership of Representative Lehman, he started this Committee on Race and Insurance Underwriting. From that, in part, is where this bill emanates from. And I don't want that to be lost on anybody because it's 3 years later, and now things somewhat go back to normal. Because at the time, everybody in the industry was talking about diversity, equity, and inclusion and some of the things that we could do to make things better and more transparent. And I think this is an effort by Representative Lehman to try to reach that. So from that perspective, I would hate for the perfect to be the enemy of the good and let this bill fail. So I would certainly hope that everyone would vote for it. That being said, again, I don't want it to be lost that it is a big compromise. And as someone who participated in that committee, along with others, I don't want that work to be for naught. So with that being said, I just want to be clear. I think we have 2 amendments, notice to the agent for the agents to be through the agent portal for the producers. And on section 5F3, we're changing that may to must. Is there anything else?
Correct. Thank you.
All right. So those are the 2 amendments that we have on the table. I will entertain a motion for those amendments. I'll entertain a second. We'll probably move the second. All in favor? Opposed? All right. With the amendments being adopted, now I'll entertain a motion on the bill as amended, on the model as amended. All right. Second? All right. All in favor? Opposed? All right. I think that. So I think I heard 2 noes. Why don't you show of hands? 3. All right. And let me see the hands of those in favor. The ayes have it. All right. The model passes as amended. Again, do we have any other business? If there's no other business before this committee, I'll entertain a motion to adjourn.
So move.
Second. All in favor? Opposed? This meeting is adjourned. Thank you.